Hello, everyone, and welcome to another edition of the COVID-19 Power Lunch. This is our weekly video series where we discuss new developments and new legislation related to the coronavirus pandemic. So for the next several weeks, we're going to focus on COVID-19's impact on the real estate market. So I'm John VanDuzer, CPA and partner with James Moore & Company and part of our real estate services team, and I'm going to be the moderator for the next few weeks. With me today, I have Nick Banks. He's principal and managing director of Avison Young. And as I've known Nick Banks, he's a very smart guy and very insightful. And so I'm really excited to hear what he has to say. And at Avison Young, he's responsible for overseeing the firm's activities in North Florida. So Nick, real excited to chat with you. Kind of curious, what's your overall, take on the real estate market today?
Yeah, well, first of all, thanks for having me, John. I really appreciate it. These are certainly unprecedented times, and so there was no trial run for this. And I think a lot of companies, really across any industry, everybody has just been trying to figure out how to survive and how to thrive and how to get to the other side of this. So it has been a challenge, obviously, for a lot of individuals and a lot of companies to navigate through these waters, but like we've seen in other economic cycles, and this one certainly is different. There has been a lot of creativity and I think a lot of fortitude and I think a lot of good news that at the end of the day, when we get on the other side of this, that will make us stronger and better, hopefully.
Well, that's a good point, and I do like to focus on good news because I feel like in the news cycle, everything is ratings, ratings, ratings. Let's hear the worst and let's hear the new cases and death counts and who's on lockdown and everything. So looking at real estate, which asset classes have been the least affected by the coronavirus?
Yeah, and I'm with you. I think it is important to look for those nuggets of good news, and there certainly have been those. So in commercial real estate, I would say there are a few that have done better than others. So I think a lot of food-related tenants and businesses have done well. So some have certainly been hurt, but I think food concepts that are drive-through in nature or were delivery in nature, they've seen record sales. Grocery has seen record sales. So I think while a lot of retailers have suffered and a lot of restaurants have suffered, there have been some segments that have thrived and actually done better. The other segment that has really performed well is industrial. So industrial continues to grow, and distribution especially. And a lot of what we've seen with online shopping and e-commerce and trends that were already beginning, they have accelerated through this pandemic. And so delivery options have become even more critical. And so we see a lot of big industrial and distribution leases. And then I would say multifamily has fared better than I think a lot of people expected it would in the beginning.
Yeah, I think I was talking to one of my clients the other day, and they were expecting their first grocery delivery service they had ever done. So and they were super excited about that. And so that's just one example of our market, our economy really shifted on a dime to some of these services that maybe 6 months ago you would have never dreamed of using, even doing a video conference like this.
Right.
I think I know the answer, but what asset class do you think was the most affected by COVID?
Well, hotels in particular, have really, they went from record occupancies in almost every market area to almost zero occupancies overnight. And there's really just no way to prepare for that. And so I think there has been a lot of fallout with hotel properties. Next after that, I think would be retail, because I think a lot of retail businesses have suffered. So much of our economy is based on retail and consumer spending. It's about 2/3 of our overall GDP, and about 60% of that consumer spending is discretionary. And so all of that discretionary spending, or almost all of it, stopped on a dime. And so retail has suffered. It seems like every day we're picking up a different news article about another retailer that is either declaring for bankruptcy or closing stores. And so I think there's more fallout to come in retail. I will say this about retail, though: retailers and shopping center owners are very resilient and creative, and they've been forced to be resilient and creative because of the effect that e-commerce and other things were having on their industry already. And so it's been encouraging to watch how some of those adaptations and some of those creative responses have come to light.
Yeah, for sure. Even in just the, slowing the spread. So I think now it's like plexiglass and the dots, for the queuing and really trying to be really resourceful and reopening, I think has been a great
Yep.
thing. So curious from the brokerage side, are you guys having any deals? Any sales happening?
Yeah. So luckily, our pipeline of deals that we were working on before the pandemic and before the close down, most of what we were working on pre-COVID, we were able to get over the finish line and get it done. And some of those transactions were easier than others. Some of them had new challenges that came up, whether it was they were lender challenges or inspection challenges or just logistics of getting people where they needed to be to make closings and deals happen. But most of what we had working beforehand continued. But for the most part, we had about a 90-day gap where very little new business started. And so I think, our industry will feel the effects of that probably later in the year, because our team would normally be busy working with businesses or buyers or sellers, on a continuous basis. There was really about a 90-day pause where very little new stuff happened. That is starting to come back. So now that businesses are reopening, the economy is coming back. We are starting to see transaction volume increase, which is a good sign. Folks are out there wanting to do deals again.
Yeah. Now with those deals that are happening, is it distressed property where maybe it was a shopping center and they're really struggling with the rent payments that they didn't get during this time, or is it just normal deals?
We haven't seen much of that yet, but we expect that we will. So what we're hearing from some of the CMBS lenders and the special services is that they are starting to see signs of default for some of these properties. And so we expect that there will be an increase in distressed properties that will hit the market. The good news to that, if there is good news to that, but there is a lot of capital that has been waiting patiently on the sidelines for buying opportunities. And so I would expect that as distressed properties hit the market, that there will be a lot of buyer activity towards those. And so I don't think there'll be a drastic drop in overall pricing or cap rates widening at a very substantial rate, because there is so much capital out there looking to acquire.
Right. No, that makes a lot of sense. And even beforehand, I know it was very competitive for, capital, a lot of capital to place. So it's really just,
Right.
I guess that's carrying in. Any significant new development activity?
I think it's a very similar answer to the transactional volume that we saw. Projects that were started before COVID are continuing on towards completion. Projects that were in the planning stages or the idea stage or being planned for 1, 2, or 3 years later, a lot of that I think has paused because those developers are waiting to see where the market will shake out. So here locally, there were several projects that were being planned and were very early stage, and for the most part I would say that those have been paused unless it was for a very specific need. So if a company had a need to increase the amount of office space that they need or a new manufacturing facility. If it's needs-based, it's getting done. If it is more aspirational or speculative, more often than not right now, those deals are being paused.
Right. No, that makes total sense. So shift gears a little bit. I've read a lot about office and how office may, just the whole concept of office may change. So I guess what do you see for the future of office?
Yeah, it's really interesting, and I think you and I have talked about it before. We've witnessed these pendulum shifts where you think back 10, 15 years ago, everybody was an enclosed office and had a lot of space, and that there was very well-defined workspaces, and maybe it was an average of 300 square feet per person, and that has been driven down, and the pendulum swung to an open environment where nobody had an enclosed office. Everybody was in kind of a shared, flexible setting for some companies, and that square footage per person got down to about 100 square feet per person. I think what we'll see now is there are two factors I think at play. One, companies have realized that some people can still remain productive regardless of where they work, whether that's at home or some other type of flexible solution. So I think geography and having everybody in the same place is maybe not as important as it was once deemed. The other thing, though, is there is obviously an increased emphasis on proximity to other people. And I think there is an awareness now that maybe sitting 3 feet away from your coworker all day long is not the best thing from a health standpoint. So I think while we may end up with fewer people in the office, we may end up with more space per person than maybe where the pendulum had swung before. The net effect of that may be companies need about the same amount of space. Generally speaking, though, I think companies are evaluating their needs and they're looking at who is really in the office, how do we really need to use our office space, and those are changes that were already being discussed, but I think they're being accelerated now because of the current environment.
Yeah. Are you seeing any trends like in design changes? And maybe it's too early to react to that, but I read where, potentially hands-free type environments would be good, where you don't really have to touch very much in the way you
Right.
move in the office. Have you seen any of that?
I haven't seen it implemented yet, but you're right, it's being talked about, and air quality is a big deal. And so what are the filtration systems that are going into office buildings? And we're in a market where there are not many multi-tenant buildings to begin with. We don't have high rises. Our company has offices in a lot of major cities, and there are a whole different host of considerations that need to be made. So if you're on the 35th floor of an office building and all of a sudden they limit how many people can ride up and down on an elevator, that impacts the ability for you to be productive and get your people in and out of the space. And what do you do at lunchtime when everybody's trying to go downstairs at the same time? How do you get there if your only option for getting to the office is public transportation? So there are a whole host of issues that are maybe not necessarily local issues, but are being talked about in major metropolitan areas that I think will help shape and define how office space is built and used in the future.
Yeah, and I wondered about that. So thank you for answering that. Like, I think the large cities and their issues are going to be different than the more tertiary markets, where I know we're based in Gainesville, and you don't see very many office buildings taller than maybe 3 stories or so. So
Right.
totally different issues. Talking about retail, we talked a little bit about them and how much they were affected. Are we seeing an uptick in delinquencies? And so I guess from the property management side, what does that look like?
Yeah, I think there have been a lot of efforts, I think, from businesses trying to retain as many employees as they can, and some of the governmental assistance programs have certainly helped with that. There's also been a lot of efforts from landlords trying to help their tenants survive, and there have been forbearance rent deals. Lenders have been working with the landlords to give them forbearance on their debt service, and sometimes that's possible and sometimes that's not, depending on the type of loan that they have. So I think there have been all of these efforts that have been very noble efforts for everybody to join together and try to create an outcome and deal with the situation. We're just starting to enter into the time, though, where some of those subsidy programs and some of those forbearance agreements that have been made are starting to burn off. And so I think now, we've kicked the can as far down the road as we can, and I think we're going to start to see, well, who can continue to pay rent and who can't, and who can continue to make their mortgage payments and who can't. So there have been closures. There have been restaurants that have closed that will not reopen. There have been retail stores that have closed that will not reopen. But I think it's too soon to tell where the fallout is really going to settle. But I think realistically speaking, there will be a sizable amount of fallout.
Yeah.
The estimations that we're hearing are 30% of restaurants nationally may not reopen or may not survive. Something like 25,000 businesses, retail businesses, will close this year. So those are big numbers.
Those are scary statistics, and I think as we all follow in the news cycle, and you hear kind of the high-profile bankruptcies, it is a little unnerving, I guess, to see that.
Yep.
What has leasing activity been like in May and June?
So I'd say in May it was still very quiet, and it was very needs based. So if a lease was up and somebody had to relocate or something like that, we were still, you know, dealing with those types of needs. Now though, we're starting to see some opportunistic leasing, you know, that because there is vacancies in some markets and some submarkets where tenants were maybe not able to find the location that they wanted, the companies that have survived and that are growing and see a strong path forward, they're seeing an opportunity to move into better spaces. And so we're starting to see some of that transpire already. So
Yeah.
that's encouraging to see. You know, there are some shopping centers though that we look at it and we say it's hard to say who may backfill a certain space. You know, there's a lot of these bankruptcies that we've seen have been larger tenants, either big box or junior box type of users that are anywhere from 10 to 40,000 square feet. And you know, in previous markets, there would be a list of other users you could go to backfill those spaces, and that list is getting shorter and shorter. So
Yeah.
that is leading to some creative uses like medical or fitness or you know, even distribution in some cases that you would not typically think to backfill retail spaces, but we're looking at some creative uses.
Right. And that was already a trend, I think, going into 2020, where we saw some pretty high profile medical and recreational and other uses, you know, filling in what traditionally was a true big box, you know, retail type outfit.
Right.
Any new trends in leasing as you're negotiating the leasing?
You know what I think we'll see in some states it's more prevalent than others, but I think we'll start to see some drive-through only concepts for some food and beverage companies. Starbucks does have some prototypes that are drive-through only. So there is no in-store service, it's just drive-through. There are drive-through only food concepts. I'm familiar with a few that are in California. So I think we'll see more drive-through only concepts, you know, is a trend that we could expect to see more of. I think we'll see this continued mix of industrial space and retail space. If you think about where most malls are located, they're in the center of urban, suburban populations. Generally, the access is very good, you know, either proximity to highways or major roads. And they check all the boxes for that last mile delivery, which has been a real challenge as more retail shopping has shifted to e-commerce. You know, people have gotten accustomed to very fast delivery next day or even same day in some cities. And the only way that's possible is to get those distribution centers closer to population centers. So I think we'll start to see a mix of distribution and retail more and more.
Right. And I was being a little snarky when I came up with my questions, but is force majeure, is that your new favorite clause in a lease to negotiate?
Yeah, now that I've learned how to spell it. Yeah, so you know, there's been a lot of attention, I think, on leases and lease language, and the other one that I put in there is business interruption insurance, and I think just a lot of analysis on how are leases worded. There are some retailers that have already changed their prototypical lease templates to include force majeure language that is it would protect them, you know, if something like this were to happen again. So I think there are a lot of things that are going to be answered, I think, down the road in some litigation that will likely happen, you know, between some landlords and some tenants. Generally speaking, though, I would say the spirit of most of this has been, we're all in this, we want to help each other get through it. But you know, some of this is going to be combative, I'm sure, and will lead to some different lease language that we'll become accustomed to seeing in future leases.
Right. And so if I was a retailer, I would want some percentage rent with a cap, you know, so that way I get best of both worlds. From the landlord perspective, why wouldn't that work?
Well, it would probably make it impossible for that landlord to go get financing, because if you don't have a predictable income stream, a lender will be reluctant to lend money on that shopping center. And so, you know, it is, I think it's all about trying to find that balance. Retail in particular has always been a partnership between landlord and tenant to some extent. I mean, they are both dependent on each other's success. And I think for the most part, try to help each other be successful. You can't have a successful shopping center without successful tenants. And so I think there is that understanding and underlying feeling of partnership in retail in particular. But tenants aren't going to be able to shift all of that risk over to landlords, because landlords need a way to capitalize the projects, or they can't build them and they can't maintain them. So I think it's all about finding that balance that works and is fair and is equitable. Understanding that, you know, maybe a situation like this happens again, and how do we not end up in this same boat that a lot of landlords and tenants and lenders have found themselves in.
Yeah, no, that totally makes sense. Kind of last question to get us wrapped up. Any new innovation coming out of this? So we've talked about more of the telework. We talked about the shifting trends in retail and delivery and drive-through. Anything else we didn't cover?
Yeah, so, you know, any time there is an economic shift like this, or a downturn or a recession, and this one is very different because this was not caused by a financial problem. The underlying fundamentals of our economy were very solid heading into this, but it's certainly a disruption. Anytime we have disruption like this, I think it always brings out innovation and it brings out change. And so I think it's important for us all to remember that every time we've been through a downturn in our economy, we have always come back. And we have always come back stronger and moved forward, but we've always come back into a different economy. And so things are different. So things are different from 08, 09 now than they were before then. Things are different now in how we travel, you know, before 9/11. And we've gotten used to those changes. So I think there will be some ongoing changes and innovation that stems from the current time period that we're living in now. Our company has made major investments in innovation, and I think we'll continue to do so, because we understand that, look, the commercial real estate brokerage has, generally speaking, been pretty archaic for quite a while, and there is so much data out there now driving decision making. So just in the last few months, you know, we've ramped up our innovation platform and the offering that we're able to give to our clients in terms of data and analytics, and just a real deep dive into demographics and things like that. We brought on a consulting team that is able to provide occupiers with a dashboard that helps them determine where they should best locate. So,
and I've seen some of those dashboards in the updates that you guys send out, and so they're very sharp. And I would encourage anybody watching that to try to look those up, because I found them very helpful, just to even get a quick, you know, synopsis of stats, you know, in the state of Florida, which I thought was really, really cool. Well, Nick, I think we're about out of time, so thank you so much for your time. I always love chatting with you and enjoy the time that we get to kind of trade ideas and everything. So thank you.
Yeah, same here. I enjoyed it.
And for everyone watching, we're going to do a special PPP broadcast this week to later, I think tomorrow, to help clarify some of the new rules that the SBA has put out. And if you haven't already watched our webinar on the PPP loan forgiveness, there's a link at the bottom of this webinar that you can click and watch, and would encourage you to do so. There's a lot of nuances and a lot of challenges, and it's something that we're here to try to help you wade through. So thank you, everybody, and goodbye.
All right. Thanks, John.